Warren Buffett, he's the godfather of modern-day investing. His $82.5 billion fortune about what shaped his investment strategy and how to master today's market.
Hey there, ready to unlock the secrets of Warren Buffett's investing success? We're not talking about some get-rich-quick scheme here. It's about the timeless principles that have made him one of the most successful investors of all time.
Exactly. You've got excerpts from The Warren Buffett Way, which is perfect because Buffett's story isn't about some secret formula. It's about consistency, discipline, and a deep understanding of value investing principles anyone can learn from.
So let's dive right into how a numbers-obsessed kid from Omaha became the Oracle of Omaha. I'm fascinated by the fact that Buffett was reading about the stock market at 8 years old. 8. What were you doing at 8?
I don't even think I knew what the stock market was at 8. It's incredible to think about. Even at that age, he was already captivated by the world of investing. But what's even more interesting is that he wasn't just reading about it. He was putting his knowledge into action.
Oh, right. The excerpts mention he had some really successful entrepreneurial ventures as a kid. What kind of kid starts a business, let alone a successful one, before they're even a teenager?
It speaks to that innate drive and business acumen that sets him apart. He clearly had a knack for spotting opportunities, taking calculated risks from a very young age. These early experiences were like boot camp for his future success.
Okay, so we've got this young entrepreneur with a head for numbers. Then he discovers Benjamin Graham's The Intelligent Investor. What's fascinating here is that this book wasn't just another read for Buffett. It was a complete game changer.
It was the pivotal moment for him. Graham's book introduced him to the concept of value investing, essentially. The idea of buying stocks that are undervalued by the market, like finding hidden gems that everyone else is overlooking. This resonated deeply with Buffett, and he became determined to learn directly from the master himself.
And that's how he ended up studying under Graham at Columbia, right? Talk about a dream come true for a young investor hungry for knowledge.
Oh, it was a match made in investing heaven. According to one of their classmates, the connection between Buffett and Graham was instant. They spoke the same language, shared the same passion for value investing. It's like they were both playing chess while everyone else was playing checkers.
So after soaking up Graham's wisdom, Buffett strikes out on his own and starts his own investment partnership. And get this, he achieves a 29.5% annual return over 13 years. I can't even imagine seeing that kind of return on my savings account, let alone a diversified investment portfolio.
It's an incredible track record, especially when you consider that the market itself experienced several down years during that same period.
Right.
Buffett's partnership, however, didn't have a single down year. This wasn't just luck. It was a testament to his disciplined approach, his ability to find those undervalued gems, and his long-term vision. He wasn't swayed by short-term market fluctuations. He stayed focused on the bigger picture.
The excerpt about his investment in American Express really highlights this. Can you imagine seeing a company you've invested in get hit by a scandal and having the composure to see it as an opportunity?
That's classic Buffett. Most investors panicked and sold their shares when American Express was hit by that scandal. But Buffett, with his deep understanding of the company's intrinsic value, recognized that the market was overreacting. He saw a chance to buy a fantastic company at a bargain price, a core principle he'd learned from Graham. It was a calculated risk that paid off big time. The stock tripled in price. Talk about a masterclass in value investing.
He essentially turned a crisis into a gold mine by trusting his instincts and sticking to his principles. This leads us to his most famous venture, Berkshire Hathaway. Now, most people associate Berkshire Hathaway with its incredible success, but it didn't start as a powerhouse, did it?
Not at all. It was initially a struggling textile company. But Buffett saw potential not in the dying textile industry itself, but in the opportunity to use Berkshire Hathaway as a vehicle for his investments.
It's like he was buying a vintage car, not for its current condition, but for the powerful engine he knew he could put in it. And boy, did he turn that engine into a roaring success. But before we get to that, I want to know more about the man behind the investments.
He's a fascinating study in contrasts. On one hand, you've got this brilliant investor who's amassed billions. On the other hand, he's famously down to earth, lives a relatively modest lifestyle, and is known for his quirky sense of humor.
It's true. The excerpts mention how he often quotes everyone from the Bible to Mae West in his annual shareholder letters. It's not what you'd expect from a Wall Street titan.
Exactly. He's comfortable being himself, and that authenticity shines through in his communication. But beyond the humor, there's a deep commitment to transparency. He treats his shareholders like true partners, giving them a clear and honest look at Berkshire Hathaway, warts and all.
It's refreshing, really. He's not hiding behind jargon or complex financial models. He's saying, this is what we're doing, this is why we're doing it, and here are the results. That kind of honesty builds trust, which is crucial in the world of investing, wouldn't you say?
Absolutely, and it speaks to his long-term vision. He's not interested in quick profits or playing Wall Street games. He's building something to last, and that resonates with people.
Speaking of building something to last, I noticed the excerpts mentioned a shift in Buffett's approach in recent years. He hasn't been as active in the stock market as he once was. It's like he's pulled back from the buffet table, even though there's still plenty of food left.
That's a great analogy, and it's sparked a lot of discussion among investors. One reason for this shift is likely due to his philosophy of buying certainties at a discount. He's looking for companies with predictable earnings, those certainties, but he wants to buy them when they're undervalued by the market at a discount.
So it's not just about finding a good company, it's about finding a good company at a great price.
Yeah.
Like snagging that designer dress on clearance. It's still high quality,
Yeah.
but you're getting a steal.
Exactly. But finding those deals has become more challenging in recent market conditions. Another factor is his concept of the circle of competence. He's always emphasized the importance of sticking to what you know, avoiding investments in industries or businesses you don't fully understand.
So no matter how tempting a deal might seem, if it's outside your area of expertise, it's best to walk away.
That's the Buffett approach. And for him, that circle of competence is largely built on traditional businesses with a proven track record. The problem is the investment landscape is changing rapidly. We're seeing the rise of new industries, tech companies, and business models that didn't even exist a few decades ago.
Which might explain why he's been less active in the stock market. These newer companies, while potentially lucrative, might fall outside his traditional circle of competence.
Precisely. But that's not to say he's sitting on his hands. The excerpts pointed out that he's shifted his focus towards acquiring entire businesses, especially as Berkshire Hathaway's resources have grown.
It makes sense. Why buy a slice of the pie when you can own the whole bakery, right? But it seems there's more to it than just having more control.
You're right. He's increasingly frustrated with the corporate governance issues plaguing publicly traded companies. Things like excessive executive compensation and short-sighted investment strategies.
It's the dark underbelly of the corporate world, prioritizing personal gain over long-term value creation.
And it's a turnoff for someone like Buffett, who values integrity, long-term thinking, and building sustainable businesses. He'd rather put his energy and resources into companies where he has more influence over the culture and decision-making process.
So it's not just about the numbers for him, it's about aligning himself with companies that share his values. But if he's shifting away from individual stocks and focusing on acquisitions, what does that mean for the average investor who wants to follow in his footsteps? So if Buffett is shifting gears towards buying entire businesses and being more selective about individual stocks, what does that mean for someone like you trying to apply his wisdom to your own portfolio?
That's the million-dollar question, isn't it? The excerpts actually offer a couple of paths forward. One option is to essentially invest in Buffett himself, or rather, in Berkshire Hathaway.
So instead of trying to pick the same stocks he would, you buy into the conglomerate he's built.
Exactly. By investing in Berkshire Hathaway, you're gaining exposure to a diverse portfolio of companies that Buffett and his team have meticulously handpicked and managed. It's a way to participate in their success without needing to be an expert stock picker yourself.
That's an intriguing option. It's like investing in an all-star team, assembled and coached by the greatest investor of all time. But the other path you mentioned seems more in line with Buffett's core philosophy, actually learning to invest like him.
Right. The other path is to take those timeless principles we've been discussing, value investing, long-term thinking, sticking to your circle of competence, and applying them to your own investment strategy. It's about becoming a student of the market, just like Buffett himself.
So it's less about replicating his exact moves and more about understanding the underlying thinking behind them.
Precisely. It's about doing your due diligence, being patient, and not letting emotions dictate your decisions. And remember, it's okay to start small and gradually expand your circle of competence over time. You don't need to become Warren Buffett overnight.
This deep dive has been incredibly insightful. We've covered so much ground. Buffett's journey, his investment strategies, the evolution of his approach, and the remarkable success of Berkshire Hathaway.
It's clear that his success isn't about some magic formula. It's about discipline, patience, and a deep understanding of both the market and yourself as an investor.
And those are lessons anyone can apply, regardless of how much money they have to invest. This deep dive has given us a lot to think about.
Definitely. It's a great reminder that investing is a marathon, not a sprint.
Absolutely. And on that note, we'll leave you with this final thought. If you had the chance to ask Warren Buffett one question about navigating today's ever-changing investment landscape, what would it be? Keep that question in mind as you continue your exploration of the fascinating world of Warren Buffett.